We want you to plan for success. Welcome to Planning Matters Radio.
Hi, Peter. It's good to see you. Today, we're going to talk about the recent market sell-off and volatility. As you know, the S&P fell 8.8% for the month of April. The Dow declined nearly 5%. That was the worst monthly loss since March of 2020. The Nasdaq retreated more than 13%. That was its biggest decline since October of 2008. And just to put it into higher perspective here, take a look at this chart from FinViz. This shows the S&P looking back for 1 month. When I see red like this, Peter, what am I supposed to think?
Well, that losses are widespread. They are not just concentrated in one sector. The S&P is 500 of some of America's largest companies, and you see red in a number of them. Now, not all of them. There are some companies that are coming back, still reporting healthy profits. But all in all, no way to sugarcoat it, Aaron. 2022 has been off to a rough start. April, when you start throwing things out like the worst month since 2008,
right?
Specifically for the tech stocks and the Nasdaq component, it still sounds like a scary and ominous thing. And April was a rough month, May off to a choppy start. And I think that we do continue to see volatility as the economic environment and the market adjust to the Fed's new direction of quantitative tightening.
Right. And that does make sense. So I just want to kind of dive in a little bit more. According to Bank of America, the market right now is pricing in a 1 in 3 chance of a recession. What does that mean?
Well, I think that we may understand that the recession or a recession feels like a period where the economy is not as robust. But there's actually a textbook definition. It's where GDP falls for 2 successive quarters. And so gross domestic product is the amount of money that is transacting in any period of time. And year over year or quarter over quarter, is it going to fall? 1 in 3 chance says there's a possibility, but not a probability, right? So there's a lot of health that is still prevalent in corporate America, in the economy, in the jobs market. They're all actually looking pretty positive. However, I do think that there is a lot of adjustment, and the market doesn't really love adjustment. So as the Fed have turned from making money basically widely available at very low cost to trying to tighten the supply of money and raising the cost of borrowing it, the market is adjusting. We're going to see fluctuations like what we saw to start the year. It's a big change in direction. And again, the market doesn't like big changes.
Right. And we certainly are seeing that. So many experts are advising investors to be defensive. What does it mean to be defensive as an investor?
Well, it means to get more conservative, to have less on the table at risk. Now, I would say that this really depends on your specific set of circumstances and what the particular account you are talking about or considering is doing, because there's a big difference, Aaron, between making contributions or just letting investments ride or taking distributions. So 3 possible choices for the direction of money. Either money's not moving, it's sort of just a stagnant account, or you're adding to it, or you're pulling from it. And there is a big difference in the results that you will get based on the direction of the market, up, down, or sideways, and what you are actually doing with your money, the direction of money, in, out, or just letting it be. And so we really need to examine what specifically each account is intended to do for us. So for example, if we had $100,000 before a sideways period in the market, which saw a roller coaster like the first decade of the 2000s, which has been called the lost decade because the market didn't really make any headway much above where it started. But it did take 2 50% declines and make 2 100% returns. Now, if we had $100,000 at the beginning of that decade, we probably would have had about $100,000 at the end of that decade. However, if we were making contributions and adding $10,000 a year during the course of that decade, we actually would have benefited pretty significantly. Conversely, if we were making withdrawals during that period of overall sideways movement, but big moves in between, then we would have actually experienced pretty significant losses over that
Mm.
time. Because if you're removing money in down markets, you lock in losses, you remove those dollars, and therefore they're not there to participate in the ensuing recovery, which
Mhm.
over the history of the market has always happened. And not only has the market always recovered, the market has always surpassed previous downturns. So if you can afford to let the money sit for a while, maybe you don't need to move more defensively. In fact, because we're already down, that might lock in losses. And it seems counterintuitive and it's kind of against our emotional response. But during down markets is actually not a great time to move more conservatively. It's a
Hmm.
good time, as long as you have a reasonable time horizon, to actually add new money or move to strategies that are more aggressive. And again, that may seem like it's against our natural emotional response that we have with our money.
So I think this segs perfectly then, Peter, into the next question. How does that advice change for somebody who's in or near retirement? Because you're talking about making withdrawals, you're talking about your time horizon, and this is very different if we are retired.
Yeah, it absolutely is. What is known as dollar cost averaging during our working years, making contributions, is a big financial advantage. However, the reverse of that, when you are pulling money out of accounts, has been called sequence of returns risk or
Right.
dollar cost ravaging. If you're doing the opposite behavior, you've got opposite forces working for you or against you. So, what was an advantage when adding money is a distinct disadvantage when removing money. So, for retirees or near retirees, you need to be paying attention to a couple opportunities. Number one, the age 59 and a half in service distribution is the opportunity for you to remove money from your 401k and possibly make it behave a little differently. Even if you're not quite ready to use it yet, you're still working and earning an income. The existing life savings that you have, you may not want to lose that money. You may want to treat it differently than the new contributions that you're making. So that age 59 and a half, you can remove the existing life-saving lump sum that you have in the 401k, but continue to make ongoing contributions. Maybe you could be more conservative with the existing money and a little bit more aggressive with the ongoing contributions. If you are already retired, you don't want to see significant losses wipe out your life savings
Oh my
without
goodness.
you having spent it or having anything to show for it, especially in the early years of retirement era.
Right. Yeah. Very well said. So, something that you touched on earlier, but I just want to ask you about because I find it so interesting is behavioral finance. I know you are a student of behavioral finance and you've studied 30 years of data. And what we learned, Peter, is that when the markets are going through a downturn, people tend to panic and sell precisely when they shouldn't.
Yeah, it's human nature. It's
Yeah.
the greed factor. It's the fear of missing out.
Yep.
As we're hearing that everybody's making tons of money, well, that means they've already made tons of money. We're just now hearing about it, but we have that fear of missing out, so we want to jump in. The market may already be at a high point, and then as we're seeing things go down, we don't like losing money. We've got the fear that we might lose even more, so we sell out. I saw an old chart. It kind of looked like yours, but it was on a smaller time frame. It was just the hill and the valley, and it said
Yeah.
buy in at the top and sell out at the bottom, and then repeat until broke. And that
Yeah.
is really, if we followed our natural behavioral and
Yeah.
emotional reactions to the market, that's what a lot of investors would do. Unfortunately, you sort of have to remove the emotion from the math and the money. And that's difficult for us to do as individuals, but it is one of the reasons, one of the benefits of maybe having an advisor who can sort of talk you through things, hold you sort of accountable for those kind of decisions, or at least speak with you about the logistics of making those kind of decisions. And importantly, have the plan set up appropriately before those market movements. Not that we know the future, but we do know and can help individuals make sure that they are allocated appropriately, regardless of whether the market moves up, down, or sideways into the future.
Right, absolutely. I know you're being very proactive about that for your clients. But if somebody would like to talk this through with you, as you mentioned, we are humans, we have emotions. What's the best way to reach you?
Yeah, you can go online. Richon Planning is what it looks like. Richonplanning.com. It's actually my last name, RichonPlanning.com. You can give me a call in the office, 919-300-5886, 919-300-5886, or email me, Peter@RichonPlanning.com.
All right, very easy. Peter, thank you.
Always a pleasure. Thank you.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.